After 2 years of relative calm, banks across the board are feeling the pinch of a record 2.8 lakh crore rupees of loan restructuring that was carried out in 2012 and 2013. With the economic downturn still continuing, most corporates are finding it difficult to pay back their dues. As a result, banks have seen a significant chunk of their fresh slippages coming from the restructured assets in this quarter. ICICI Bank has seen fresh slippages of over 1600 crore rupees in the second quarter, out of which 800 crore rupees was from restructured assets. Central Bank of India also saw slippages of 1700 crore rupees, out of which 1100 crore rupees came from recast loans. Same was the story with Union Bank of India, Bank of Baroda and Bank of India.
The addition to NPA, as I mentioned, was a little over 1600 crores, but out of that 800 crores was just slippage from the existing restructured portfolio. New additions to NPAs as well as restructured put together should still be lower than the new additions that took place last year.
But that may be easier said than done.
When we restructure our accounts, it is done on certain assumptions, certain premises, which also includes overall improvement in economic environment. Unfortunately, some of these assumptions have not proved correct, which has resulted in some of the accounts getting downgraded.
In fact, the RBI's new guidelines on loan recast have come as a blessing in disguise for banks, forcing them to go slow when it comes to corporate debt restructuring. And with the man in charge, Admin Street, cracking the whip, banks are sure to be selective and entertain only viable projects. Simran Gill, ET Now, Mumbai.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.